Why Schwab, a financial giant, got hurt in the regional bank's panic. Like Silicon Valley Bank, the company holds billions in bonds that have declined in value, but it has access to billions in cash if needed, analysts say, and is much more diversified. Well, if we take a look at the Spider S&P Bank ETF that tracks how the banking sector overall is doing, after the SVB announcement back on March 8th, it looks like the industry as a whole has taken about a 23% hit. And Schwab in particular has taken about a 32% hit since then. So then the question remains, is the New York Times correct? Is there a difference between Silicon Valley Bank and large corporations such as Schwab? And the simple answer is yes. And in order to explain the difference, we need to explore the differences between SVB as a company and Schwab and other Schwab-like companies. So, what were the reasons for SVB's failure? Simply put, there was a macroeconomic factor caused by the Fed that led to the collapse, namely rising interest rates. In order to combat the increase in inflation, the Fed has been steadily raising interest rates at a pace that the banks did not foresee. Whether or not they should have foreseen it is a different issue, as the Fed has very limited levers in which to combat inflation rates. However, that's a topic for a different time. So what caused SVB's failure? This rising interest rate environment led them to have an increase in unrealized losses in their portfolio, given that they had invested in long-term low-yield bonds with their depositors' money. When the depositors then wanted to pull their funds from it, they needed to then realize those unrealized losses, meaning things quickly spiraled out of control. People were tipped off to this back on March 8th when SVB had announced that they needed to raise additional rounds of funding. When investors and depositors took a look at what the reasoning was, they realized the huge amount of unrealized losses in SVB's books. It caused a large bank panic, which led to all of them trying to pull their funds out, a classic run on the bank, which caused SVB's failure. Now, the speed at which this bank run happened was largely due to the fact that SVB had a very concentrated client base, namely mostly venture capitalists, startups, and people in that niche industry. And the people in that industry are very well connected together. And as soon as people realized what was happening, many of the large VCs privately told their investment portfolio companies to go and pull their cash, just in case, which caused this to happen. So, what about Schwab? Well, Schwab faces the same exact macroeconomic conditions that SVB did, namely the rising interest rates. And Schwab also holds an increased unrealized losses in their portfolio holdings. However, unlike SVB, Schwab, which is known for its retail investment branch, holds a much more diversified client base that leads it to be a lot less panic-driven across the entire sector than SVB was. Secondly, as the New York Times notes here, it does have access to billions in cash if needed through the federal government, as well as Schwab itself being a much larger entity. To make this point, let's take a look at First Republic Bank, which is a regional bank, much like SVB was. Due to the fact that First Republic has much of the same risk factors as SVB, it took a much larger hit, about a 90% drop since March 8th, than, say, Schwab's stock of only about 32%. That's not to say that Schwab itself doesn't have any risks to contend with. This increased unrealized pool is a concern, as well as its low yield savings accounts, which is leading many clients to pull funds from Schwab to go chase higher yields elsewhere. However, not everything is doom and gloom for Schwab. As we can see, reporting from Bloomberg, Schwab ETF logs 4.6 billion inflow in quarter-end shuffle. Uh, as people and investors are deciding where to park their funds, there is a large amount of shuffling going on between different cash and cash equivalent accounts. And part of the inflow is going into Schwab's ETFs that cater to such funds. So, is Schwab going to go the same way as SVB? Very unlikely to do so, given the differences between SVB's business model and Schwab's business model. However, the banking sector as a whole has much to contend with, especially as the Fed may continue to raise interest rates to try to combat the continuing inflation going on in the US markets. Lastly, there have been some analyses coming out as of a few days ago, especially from folks like Seeking Alpha, saying that Schwab might be a buy and that the sell-off has been currently driven much by panic. Let's take a look here at the Seeking Alpha article. So, is Charles Schwab stock a buy during the dip? According to the value pendulum, yes, things are not as bad as feared. It echoes much of the sentiment as the New York Times article states, where it believes that the sell, because of the speed at which it sold, namely on March 8th, might be due to the panic sell. So, what do you think? Is Schwab a buy or a sell? As a quick disclaimer, I personally do own a bit of Schwab, although I hope that that does not impact my analysis of the news here. Thanks, and have a great day.